I got to first ask you about the talking point today. Urjit Patel, the Reserve Bank of India governor, asking the Fed to slow down their pace of QT, or quantitative tightening. I guess my question is, should the Fed, whose mandate is domestic, care?
I think to some extent they should care because, of course, if you look at the S&P 500, 60% of the top line growth comes from overseas earnings. And overall, the Fed has always been, as you indicate yourself, been looking domestically. I think actually a lot of the miscalculation they're doing in terms of the forward projection actually comes from the fact they are so domestically oriented. I think the RBI governor is right in the sense that monetary policy globally today is much, much tighter than you can actually see from the short-term interest rates.
And Steen, that's the other point, right? The bigger picture is, should monetary policy as a whole globally, should it be this tight? I mean, is the global economy strong enough for these conditions?
No, I don't think it's strong enough. If you look at the OECD diffusion index, the latest numbers out is below 50, indicating that the world is coming to a standstill in terms of growth. If you look at the quantitative tightening in the Fed balance sheet, the monetary aggregates falling, and what we as Saxo look at to a large extent is the credit impulse. How big is the credit cake? And the credit cake globally has been contracting for a while. So I actually think that the incoming data is far more negative than the historic data. But the problem is monetary policy is always done with a perfect 2020 rear vision mirror. In the sense they're looking backwards. And I think you pointed to it exactly. Fed remains too orientated toward domestic returns. And look at global returns this year. The only market really up this year is technology in the US. Even the S&P 500 is up small. Everything else is down. High yield credit is down. Emerging market is down. China is down. Japan is down. Emerging market overall is down.
Steen, adding to the concerns, you call Spain as well as Italy time bombs. We've seen the fallout. How much worse will it be when it explodes?
First of all, the situation in Spain is more a domestic one. It is the first time in the democracy of Spain that you had confidence vote lost by the sitting government. So there is a upheaval in terms of the political process, and it can get as nasty as it is in Italy right now. And in Italy, the case is that more than 50% of the population doesn't want to be part of the EU, doesn't want to be playing by the rules. The early indication in terms of the government that we saw yesterday was immediately to increase the pension and reducing the pension age. It was to go back to a lot of the very, very spend-driven initiatives that's been in their original program. But it is a long fuse, and don't forget, Greece lasted for 6 years, and this will be in the process for the next 6 to 12 months. I think globally right now, there's so many unknowns quantities that the market has really given up and is just waiting for one of these two things to play out. But I don't think Italy on the short term is going to be that issue that will drive the market.